4 weeks of declines just snapped. Global gold prices are surging for the first time since June, signaling a massive shift for your portfolio. The price of gold has jumped 4% in a single day, reaching $1,870 per ounce, its highest point since March. This sudden surge is being attributed to a combination of factors, including rising inflation, a weakening US dollar, and increased demand from investors seeking safe haven assets. For example, the SPDR Gold Shares ETF, a popular gold investment vehicle, has seen a significant influx of capital in recent days, with over $100 million in new investments in just the past week alone. In a related story, we're going to talk to an immigrant business owner who embodies the American dream, but is now speaking out against a practice that he believes is a slap in the face to the values of hard work. Here's the setup. The US dollar has been taking a hit, showing significant weakness across the board. This isn't just about currency fluctuations, it's a direct signal from the global markets. Investors are also heavily anticipating the Federal Reserve to loosen its monetary policy, a move that historically sends ripples through every asset class. When the Fed eases, money gets cheaper, and traditional safe havens like gold become incredibly attractive. This confluence of factors creates a perfect storm for precious metals. In recent months, the dollar's decline has been stark, with a 10% drop against a basket of major currencies. For perspective, the dollar's value against the euro has fallen to a 2-year low, with the euro trading at 1.15 against the dollar. Look, the data from Don Tree, a major financial news outlet, confirms it. World gold prices have seen a powerful recovery. This isn't a minor bump. It's the first weekly increase we've witnessed since way back in June. For months, gold was on a downward trend, leaving many investors on the sidelines. But this turnaround, fueled by the weakening dollar and anticipated Fed action, is a hard signal. It tells us institutional money is moving, and fast. You don't see this kind of reversal without serious capital flowing in. According to the World Gold Council, global gold demand hit a 2-year high in the first quarter of 2023, driven mainly by central banks and investors seeking safe haven assets. This surge in demand has led to a significant increase in gold prices, with the price of gold per ounce rising by over 10% in just a few weeks. Here's what nobody mentions. While mainstream media focuses elsewhere, this gold surge offers a concrete opportunity to hedge against a weakening dollar and potential inflation. You can profit by strategically adding gold exposure to your portfolio. One actionable step you can take today is to research gold-backed ETFs, exchange-traded funds, like GLD or IAU. These are accessible, liquid ways to get exposure without buying physical gold. Understand how they track the market, then consider if they fit your risk profile. Don't wait for the crowd. Position yourself now. If you want more strategies on how to capitalize on market shifts like this, hit that subscribe button and join the community. Top-tier strategists across Wall Street are openly shifting their outlook. Analysts at firms like Goldman Sachs and JP Morgan, previously cautious, now flag gold as a critical hedge against broader market volatility. They're telling high-net-worth clients to reevaluate their asset allocation, emphasizing gold's role as a store of value when fiat currencies like the dollar face headwinds. This isn't just about preserving capital. It's about positioning for substantial upside when the global economic landscape is this uncertain. Savvy individual investors are taking notes, knowing that following the smart money is how you truly build wealth. The chatter on Bloomberg terminals is all about this pivot. The play here is clear. Follow the money. Beyond the US, major global economies are feeling the ripple effect. Central banks in emerging markets, especially, are reportedly accelerating their gold acquisitions, a direct response to the USD's dip and the Fed's dovish signals. This isn't charity. It's a calculated move to diversify national reserves and shield against currency devaluation. For individual traders, this creates arbitrage windows in international gold markets, or even opportunities in foreign exchange, if you're tracking these shifts closely. Think about the implications for cross-border e-commerce, or even the demand for gold-backed digital assets. Some countries are clearly making a power play. and you can ride that wave. A similar market dynamic unfolded in the early 2000s, where a period of sustained dollar weakness combined with accommodative monetary policy fueled a multi-year bull run for gold. Those who recognized the pattern early saw their portfolios absolutely explode. We're talking about a time when astute private investors started buying physical gold or mining stocks, capitalizing on a trend before the masses caught on. The lesson from that era is simple. When the fundamentals align like this, a depreciating reserve currency and a central bank leaning towards easing, gold becomes a magnet for capital. It's not just a repeat, but a playbook for profit. Who's cleaning up right now? Gold miners, obviously, but also specialized logistics companies moving precious metals and even online platforms facilitating fractional gold ownership. These are the unsung heroes turning a profit from increased demand. On the flip side, businesses deeply reliant on a strong US dollar for imports are feeling the squeeze, seeing their costs rise. People holding significant wealth solely in dollar-denominated cash or bonds are effectively watching their purchasing power erode. This shift creates a clear divide: those who adapt and those who get left behind. It's about spotting where the wealth is moving. According to a recent report by the World Gold Council, the value of gold reserves in the U.S. has increased by 12% in the past year alone, with investors flocking to the safe haven asset as a hedge against inf.